I mean, as I mentioned, the market is possibly in a state of flux with all the geopolitical uncertainty in the Middle East. On the other hand, everyone's also so nervous about China still, despite the announcements of a fiscal stimulus. Plus, there's the added layer of uncertainty just 2 weeks before the US election. Even then, what we may see is, while we may see people exiting their short positions, for example, or taking profit at some level, for them to take a more directionally certain stance, I think there just needs to be more clarity.
Hello, and welcome to the 9th episode of Oil Insights. I'm Martha Dowding, your host, and I'm joined by Mita Chaturvedi. Before we start the show, please like and subscribe to the podcast. I invite you to visit Onyx LinkedIn and YouTube channels for more interesting and exciting content. In this episode, we will review the latest moves in oil prices and where Brent may be heading by the end of the week. At the time of this episode, front-month Brent is trading just shy of $75 a barrel. We will also dive deeper into the commitment of traders data provided by the exchanges and our proprietary positioning data for CTAs to whether speculative risk takers have materially shifted their length. This week, if we had to think of three main drivers for the price of Brent, it would probably be the potential for a geopolitical flare-up, the positioning from the COTs and the investor risk appetite with more shorts to cover, and the US soft landing expectations. So beginning with geopolitics, the current situation seems to be a normalization of market attitudes surrounding the conflict, as although the humanitarian crisis only worsens, the points of sensitivity to the market are clear, and these don't seem to be the targets right now. There were more strikes from Hezbollah into Israel this morning, with medium-range missiles being used for the first time, targeting an intelligence office in Tel Aviv and a naval base in Haifa. This shows a change of strategy from Hezbollah, and we continue to see missiles pass through the Iron Dome. Will this push Netanyahu to act faster? Vulnerability is dangerous, and his responses have naturally been strongly worded, but we are yet to see Israel's strike on Iran. In my opinion, we should still expect to see a strike on military assets in Iran. We've seen a little volatility come back compared to the flat, low volatility we saw last week, but the high volatility event is likely to be these aforementioned strikes. Mita, what's your take? Do you see the potential for more geopolitical flare-ups this week? Has the market grown numb to the developments?
As you said, I wouldn't wish to underestimate the potential of a geopolitical flare-up, in which case oil prices would be driven higher. Ceasefire negotiations have stalled since Israel killed Hamas leader Yahya Sinwar, and Antony Blinken, US Secretary of State, is currently in the Middle East for his 11th visit since the war started to try to get them to start these negotiations again. But meanwhile, Israel continues to launch attacks in Gaza and in Beirut. The military has said that they're going to try attack financial institutions allegedly linked to or affiliated financial institutions allegedly affiliated with Hezbollah, and has vowed that Iran will be paying for Hezbollah's drone strike in Caesarea, as you mentioned. Iran, on the other hand, has said that the US will be responsible for any Israeli attack on the country. So there definitely is potential for further flare-ups in this devastating conflict, which may continue to keep a floor on oil prices in the short term. However, any significant rally, I believe, would require just a more significant disruption to oil supply if Israel attacks oil infrastructure in Iran. But right now, I just don't know if there is still very little clarity of whether that will happen. So I guess the market is just in a bit of flux because of that.
So turning to the market positioning, so this is really important to see, as you mentioned, how the market can react to this bullish or bearish news that may happen. How has the market normalized? Has it normalized? So looking at Brent, the ICOT data for the week to the 15th of October, that is a week ago today, we can see the changes in managed by money positions. We look at these because they best represent the speculative flow of money. So the uncertainty generated by the factors last week, where we saw this heavy sell-off, seems like such a long time ago now, led to pretty significant de-risking by long managed by money players. So they trimmed about 20 million barrels, which is just under 9% of their positions, and they added around 7 million barrels, about 8.5% to their shorts, so a bearish positioning change. It brought net length to about 120 million barrels, which isn't particularly high. It's about the 15th percentile for all weeks since 2013. So we're looking at a bearish bearish market. There is a bearish skew here, but there has been a little relief from the negative levels net positioning that we did see the other day, must be months ago now, maybe a couple of weeks ago. But as I mentioned, it is really important to consider how backwards looking this COT data is when it comes from the exchanges. We're at Tuesday now, and this is backwards looking from the previous Tuesday. So using Onyx's proprietary CTA model, we can see the movement in CTAs in this time from the release of the CFTC information. So there was a drop in net positioning from CTAs immediately following the 15th. And this shows the importance of having these granular models and having this data. So looking at the total CTA net positioning for the selection of energy futures, net positioning dropped from about minus 23.7 thousand lots on the 15th to more than minus 100,000 lots on the 22nd. This is a really significant drop, and the Brent component of this dropped from close to flat to around 19,000 lots short. So it was really significant movements in not only the total future CTA, but the Brent specifically. And this shows that the crude market may have a greater short side saturation than we may have seen in the ICE COT report. So even though the price and the flat price hasn't dropped significantly, the positioning of the market has. So I find that very interesting.
That is true, yeah.
So looking at this positioning in the COT, well, how do you see the money managers' attitude towards risk?
I mean, they're definitely very risk off, and I'm not really surprised as to why. The market is definitely waiting for more directional certainty before proceeding to deploy more risk. I mean, as I mentioned, the market is possibly in a state of flux with all the geopolitical uncertainty in the Middle East. On the other hand, everyone's also so nervous about China still, despite the announcements of a fiscal stimulus. The IEA's executive director, Fatih Birol, mentioned in an interview this week that global oil demand is much weaker than in previous years and is expected to remain weak due to China, specifically China's oil demand. Plus, there's the added layer of uncertainty just 2 weeks before the US election. You see precious metals reaching all-time highs, gold breaking new highs. And yeah, so I do think we may see more volatility in the medium term because of how short everyone is right now. I don't think we'll be in this low volatility range-bound regime forever. But even then, what we may see is, while we may see people exiting their short positions, for example, or taking profit at some level, for them to take a more directionally certain stance, I think there just needs to be more clarity.
And how are the CTAs looking in terms of the products? Like I mentioned Brent before, we also have a few of the more US-based products there, which might link us a bit into looking into the US. How are they looking?
So CTA positions remained net short in gas oil, heating oil, and RBOB gasoline futures throughout the past fortnight. So I think Brent saw a bit of a correction upwards, so did WTI, and then went back into net short positioning. But for the products, things have been net short throughout that time, although they did see a bit of a correction upwards as well, alongside the crude futures. But we do see them get shorter into the week of 15th October. That is a week after, as you mentioned, the official ICE COT data. As of today, that is the 22nd of October, positioning in RBOB stood at negative 23,000 lots, down 84% week on week. And heating oil futures today were at negative 18,000 lots, down 365% week on week.
And like fundamentally, in terms of like stock levels and stuff, how is that looking in the US?
So for heating oil, I mean, there was weakness last week. Just to first talk about price action, there was weakness in line with like the crude futures, but since range bound regime may also be because as in terms of stocks, last week saw a 3.5 million barrels draw in US distillate fuel oil stocks, which may have injected support. Although CTAs are still selling. I think it'd be really interesting to see this Friday's official GOT data, just to see how whether there was more support by other players, maybe producers and merchants doing something. But there definitely is a small improvement on the supply side, considering the EIA's data. But at the same time, distillates has been seeing some level of I think demand's just not been great given all the weak manufacturing data just globally. And maybe things may improve just as we come closer to winter. I know Japan, I know it's not the US, but just in the East, for instance, we're seeing just some level of, there is kerosene buying by Japan just for winter stockpiling reasons. So exactly. So I don't know if so we may see an improvement in demand perhaps just close to winter, but so far things are just low volatility range bound. It'd be interesting to see just what happened there.
Yeah, I mean, net positioning from money managers in heating oil is so low, and it is draw season in the stocks. So I think all eyes will be on the manufacturing data from the US, which, looking at the US, it's looking pretty rosy recently. In the US, it seems the Fed is likely to pull off their soft landing, which has implications for the path of policy rates. Given the latest data, it seems like an incremental approach to cutting rates is the way to go. And this kind of precludes the outsized 50 basis point cuts, which may prove disappointing for equities and other risk assets like oil. Do you think the more positive evolutions in the US that we have seen, we've seen data come in better than expected. It's not been good, but we have seen some better than expected, retail sales and employment. Do you think that this is sufficient to fill the sails of the bulls and, raise that risk appetite that you said is lacking?
Yeah, you're right. I do not see another aggressive rate cut, as you mentioned, and I expect that the market knows this. Data has been nicer, and as you mentioned, and it looks like the Fed may pull off a soft landing. We may see small bullish absorptions into the market with more rate cuts as and when we see them, but I just don't see anything necessarily overexciting the bulls. I don't think anything's going to come that's going to be like another 50 basis cut or just like something more aggressive than that. Various officials from the US Fed have also attested that they believe that the move to lower interest rates will be more gradual and patient. It'll just be a more long-term approach, which may not do anything too significant to risk assets such as oil.
So, as with every episode, you may be familiar now, we have our crystal ball moment. So we're thinking about where Brent may end up at the end of the year. We're coming to the end of October now. What do you think by the end of the year? Has your opinion changed in the past few weeks?
No, not really. I remain bearish. I think except for like one episode of these where I was slightly bullish, I've just been bearish for like a while. But while I remain bearish, it's not without multiple asterisks to account for geopolitical risk and the robustness of Chinese fiscal stimulus. And again, the US Fed's trajectory, as we mentioned. But right now, I believe for just at the end of the year, I think Brent could be between $70 and $75 per barrel.
Yeah, I find it kind of hard to argue with you. I think that we may be in for a bullish rearrangement, and I think the opportunity that some geopolitical injection of bullishness may bring could be sold into really well and kind of rebalance the market. It's really hard to say with the current lack of clarity in any direction. So as I said, US data is beating expectations, but is not good. Yeah. The leading economic index in the US fell more than expected. So the momentum of the strength is still expected to weaken. So everything is kind of contradictory with the backwards looking data kind of focused on by people. But even then, it's not, it's not blowing you out of the water. Rate cuts could be a bullish story, but people could then be like, the Fed's desperate. There's always that, flip side that we saw with the Chinese stimulus. And will the Chinese stimulus work? And will it work by the end of the year? I think that these are the kind of things that just, I don't see these steps happening yet, and it's becoming closer and closer to those times. We've got bonuses at risk. I think the risk appetite for traders is pretty burnt. I think we've seen some pretty big swings this year. I know in the products and in crude, there are people ouching, to coin a phrase. And I think that people may be risk off into the end of the year. And I think that we have such a comfortable home in the low 70s. So we may continue to see that, as you said.
Yes, I agree with you. Just we've seen gasoline see some support weeks, if not months, after just like whatever just this summer was. So I completely agree with you. We have reached this low volatility range bound regime, and we might not break out of it for a while, just given just all the ouches, as you just said, everyone's seen this year.
Yeah, pending the risk. So this brings us to kind of our concluding remarks. Do you have anything in particular to keep an eye out for this week in the markets?
Well, I mean, everyone will be watching out for what Israel's next move is going to be, with President Biden's statements last Friday, I believe, about how I think he said yes and yes when asked whether he knew what's going to happen between Israel and Iran.
So he was asked, does he know exactly what their plan is?
And just like, the severity of it, I think. And he said yes and said no further comments. So I think
I'm convinced.
with that and the upcoming US elections as well, there's just going to be a lot more uncertainty in the market as to what's going to happen. It'll be interesting to see. As I mentioned, precious metals going all-time highs is not necessarily a good indicator of volatility. That means people are looking out for safe haven assets, which is not necessarily a good thing for risk assets like oil. So I think, and just because of how critical the Middle East is for oil specifically as well, that's just going to be something everyone's going to have their eye out on. Yeah, so I think that'd be an interesting thing to look out for this week.
Great, thank you. And thank you for joining us today. Until our next episode, don't forget to like and subscribe.